A lot of the impact is very localized on certain industries. So whether it's furniture makers or steel consumers or other areas that have to import. I think there's the short-term negative when companies have to readjust, but the long-term, and I've heard CEOs say this, where CEOs that have said, we have to deal with the tariffs, but we have a sophisticated global supply chain and we will adapt. The reason China got to be such a large supplier was because people adapted their supply chains to that. So it is clearly a short-term disruptor. On the wage side and the employment side, we've been looking at surveys for months, especially the small business survey, where getting good workers is one of the most difficult things for all businesses. The flip side of that, that's what's really been driving the unemployment rate lower, where you have semi-skilled, unskilled workers. Those unemployment rates have come down the most in this economy, and that's what we think can really give sort of a floor to some of the growth concerns we see in the medium term.
Grep Ip, do you think that the Fed has the markets back, so to speak, that they look at what's happening with tariffs, they see the unsettled nature of the stock market as a result of what many CEOs are saying and what the earnings and projections have been, and will react accordingly, or do they seem set on their course?
You know, I think what the Beige Book underscores is that there's a lot of sort of peripheral evidence out there that we're in an environment where price and wage pressures are starting to, you know, the risks are to the upside instead of the downside. This isn't new. You know, Jay Powell talked about that at his last press conference. He also underlined that as far as they're concerned, the tariff problems are so far relatively small. Next to the very tight labor market, I really think they're not their number one inflation concern. But what I think for the Fed, what it means is that their path forward is much more symmetric in the sense that they can see themselves moving faster just as easily as they can see themselves moving slower. And I think that's basically what's shaken up the markets now. They're coming off a period of 7 or 8 years when the Fed always erred on the side of going slower or actually easing policy. Getting used to that two-sided risk has got to add risk to the equity market and the bond market.
But they only seem to be acknowledging one side of that equation. I don't hear anybody, especially the Fed chair, Mr. Powell, coming out and saying, well, we'll go slower if we have to. This is like, we're a long way from neutral. We could go past neutral. There's nothing that they've said, and that almost goes down the list. That says we're really worried about some of the things we're hearing from corporate America, and if we have to go in December and then have a seat, we're willing to do it.
Well, that's absolutely right. But if you actually listen to Chairman Powell's overall arching view of the world out there, he has displayed much more agnosticism about whether we reach some kind of natural unemployment rate that triggers almost an automatic inflation response. So on that front, yes, he's not saying we're going to cut rates, but it sort of displays a kind of an underlying dovish tendency, which I think, you know, will actually hold the market and the bond market in good stead, provided his assumption that this doesn't trigger an inflation explosion proves to be correct.
When he made those comments, though, he said that it was about signaling predictability, what the Fed was going to do. Michelle, does that make any difference to the markets right now, knowing what he intends?
Well, first of all, I think the Fed themselves have been clear that going forward, there is no preset path. And I think, speaking to what Greg has mentioned, that you do have a Fed that is becoming increasingly data dependent as they get into the range where they think neutral is. That's more uncertainty, that's more two-sided risk, and that's something that the financial markets are going to have to deal with for the first time in a long time. I would just take exception, I guess, to the idea that all their comments have been one-sided. And again, someone echoing what Greg said, I think the references that Fed Chair Powell has made to the late 1990s episode, where he talked about the fact that, you know, Greenspan understood that there were other things going on. There were reasons why, even though the unemployment rate was low and wages were rising, it made sense to hold off, to wait until you actually saw the inflationary impact of that before acting. I think, to me, those are signals that this Fed, and exactly as Greg said, that there is an openness to thinking that the world may be working differently, that the transition from wages to higher inflation is less clear. And in that sense, it isn't just the fact they keep hiking and hiking because the economy is doing well.